What is going on, everybody? Welcome on into today's stream. We've got Mr. Powell on deck. The Federal Reserve announcement, how much they're going to raise rates, is going to be coming out in about 7 minutes from right now. And then in about 37 minutes, we're going to have Jerome Powell live here on the stream. We'll get his commentary, we'll get the questions, and we'll listen to what he's got to say. And then we'll see how the market reacts. All that good stuff. We shall see. 5-minute chart. Oh, yeah, 5-minute chart is, I mean, honestly, a lot of charts are going to be kind of useless in the next like hour, 2 hours. We're going to see what happens today. We had obviously a move in pre-market yesterday off of CPI up to about 413, 414 on SPY. Came back down to about it actually just came down to about 399. And then it kind of bounced about some higher lows. I'm building some higher lows since, but we're going to see if that trend continues. I think the biggest keys for today, do we close over 410 or do we close under 390? Now, 390 is kind of far away. We could totally get there, but it might not happen today. Obviously, if we go down, like, do we go under 400 first? And then how far down? 395? Like what level are we looking at to the downside? 390 is the key. So a close over 410 or under 390 is a lot more significant in my view by the end of the day today. Hopefully it gives us a better sense of direction and all that good stuff. We shall see. But today's price action, as we look at SPY right now, it is up about 0.72%. A little sketchy, I would say, going into the FOMC, because we've seen time and time again the first move is the false move, although I don't really want to count this as a first move. The first move is a false move, meaning the move that we get off the initial rate hike announcement document, and then Powell comes back and tends to reverse things. I'm not going to sit here and try to guess. I'm not in any positions. I have that wall. I guess in terms of, short-term stuff, long-term stuff is what it is. I'm not selling that stuff anyway. I just have that strangle that we had. We made that on Monday, I think. But which, by the way, we are the definition of how to lose on a strangle right now. Although it expires Friday, so I'm not really too worried. I guess I could have bought it for cheaper technically now if I had bought that strangle. But I have a 390 put and a 410 call, something small, just for fun. Expecting a move out of to the upside or downside. I don't know which way, but I'm expecting a move in one way or the other at some point here. The thing is, though, we have been in this range, right? So the bottom end of the range is down low 390s, and the top end of the range has kind of been in this like low to mid fours. We've actually come up to about 410. So we've been in this like really kind of weird range for a month. It's been over a month. Like November 11th was the day that we got up into like the 395 range from being down in the 370s like the day prior. And we've been here for a month. We can't break 410. We also can't break 390. So we're just like, come on. And when we get these types of consolidations, usually there's a pretty big move that follows. Usually, we don't have to get a big move, but usually there's a pretty big move that follows. So hopefully we get something. Going to strangle. I think that's a decent way to go. Straddles, strangles. I think it's a decent way to go. But to be honest, mine, let me just check in where it's at. I think it's down. Well, I guess it's not as bad. No, it's not as bad. It's up 16% today. The call's what's paying. The 390 put is essentially worthless. The call that I have, the 410 call, has some value. Ideally, if we get a big move, right? Ideally, then, if it goes over 410, 415, 420, dare I say, it's a big move. But if it happens today, tomorrow, we get something like that, then it'll pay a couple $100, which is kind of cool. But if we end up finishing Friday and we're somewhere in between 410 and 390, it's going to expire worthless. I'll probably salvage it for something, but it's essentially going to expire worthless. So I would like a move, something. That's all I'm betting on essentially. But outside of that, directional bias, I don't care. At this point, I would love to see just some direction so we have a better feel for what's going to happen next. But that's my take on it. We are going to get the announcement in just a minute or in 3 minutes. So we're going to see. Flip us in the house. Hope you guys are doing good. James, 4,200 and dump. Crash is coming. I mean, if we're going to get a crash, like give us a crash. Like give us something. The only problem is that I don't know. I really don't. I would be very surprised, right? Powell would have to say something pretty bad, or would have to say that we're going into a recession. It's going to be horrible, which he's not going to say that. But if he did, then I think that's the reality of downside, right? That's where we go down from here. CPI is not going to be like, oh, CPI came in really hot and it's going back up. It's probably not going to be that case anymore. But with that said, I do want to mention before we get into the announcement and before we get into the reaction and then Powell in a half hour, I do want to thank the sponsor of the channel for the week. Again, that is Chart Prime. You guys can actually see I have some indicators pulled up. Bullish engulfing pattern right here, bearish engulfing up here. It's just some of the candlestick patterns that I have overlaid on the charts. But Chart Prime essentially is like your own AI, your own bot that's going to auto-detect patterns, auto-detect, cool setups that you want to follow, wedges, reversals, all that great stuff. It's like having them on your side on top of a Discord community, on top of trade ideas, on top of having access to tutorials and all that great stuff inside the Discord community. I'm going to leave a link down below to Chart Prime. Also, they have a exclusive 45% off link, which will be linked up in the pinned comment of the stream and also in the comment section down below if you want to check them out. And thanks to Chart Prime for sponsoring our videos. I'll leave them up here because I like some of the candlestick patterns to see the bullish engulfings and stuff. If you're kind of zoomed out, you might not be able to see it as well. So let's see how it plays out. So far, it has worked decently yesterday and then a couple times yesterday. But so far today, again, you got to take this stuff with a grain of salt because when it comes down to it, right, today's action after the morning open, like, should we expect big moves going into this FOMC? Like, probably not. Everyone's going to be waiting for the actual results, right? So that's what we're waiting for. So we'll see what the first reaction is. Ideally, I want to read the document to see how it sounds. And then we'll wait for Powell's press conference, which is obviously going to be the most important part. Well, maybe not necessarily, but it's a pretty important part of all this stuff because what he says, the market's going to react to, whether he says that he, intends that or not, right? So we shall see. We shall see. One Fix It Man, remember to like button and subscribe if you guys are new. Boom, here we go. Here we go. So we are now at 1 p.m. Initial reaction is a little dump down to 402, 402, 403 or so on SPY. Give me a second. Once we load up the actual FOMC statement document, then we'll get rolling in terms of reading through it and all that stuff. They were expecting a 50 basis point hike, and the Fed raises by 50 basis points. So here's the confirmation here. The Fed raises the benchmark rate 50 BPS to 4.25 to 4.5 target range. That was expected. Nothing crazy there. We got what we were expecting. Market's selling off a bit off of that initially. I will say, though, the initial move has been the false move, although there's been a lot of false moves. It has been the false move in the past on these FOMCs like we've been talking about the past couple of months. So let's see if that actually sustains, okay? In a few minutes, I'll pull up the document. We have about 30 minutes until Powell comes on. Let's see how this reacts for a few minutes, though. Pull up the document, see what we can make of it. How does it sound? How does it read? And then ideally from there, we got Powell. I want to also do an audio test. Here is, I have the link here. Here's the FOMC, the link to the press conference, but they're not live yet, obviously. I've gotten copyrighted for the music and stuff before, so I'm going to keep it muted for now. We'll do an audio test in a second just to make sure everything is working well, but I think I tested it before. It should be good. Should be good. Why is market selling off? Well, maybe in this sell-off, we're going to have a potential more hawkish tone from the from members. I'm going to pull that up in a second here. See once I can get that up, then we'll run with that. But that was the official news there. Let me just pop this over and pull it up on the side in the meantime, and we'll see how this reacts. So far, it's not really dropping much below 402, and now it's actually dropping below 401. 401 or so is now actually testing on SPY. So the lows of yesterday came down to about, that's a pretty big dump there. It came down to about 399 or so. Let me see what the 10-year is up to. Let's check out the 10-year. 10 years, is it moving up off this? 10-year popped up to about 3.55, then it pulled back at 3.52 or so right now. The dollar, DXY, just had a nice little pop off of that initial reaction. So far, the initial reaction is not good in terms of where the market's at. SPY is back at $400 now, 399s. Here we go. We're testing the lows of yesterday now on SPY. Fed median forecast shows rates at 5.1% in 2023 and 4.1 in 2024 in terms of the Fed median forecast. I'm curious now, though, how Powell is going to react to this, as we have been curious over the past couple of FOMC meetings. Pull up CNBC. I should be able to get the article. We can dive into it ourselves, make our own opinions from it. Fed raises rates to a half basis point to the highest level in 15 years. Highest level in 15 years. There she goes on the CNBC article. Keeping in line with expectations. It's kind of one of those things, though. This is pretty highly anticipated. It was not like we got something crazy, you know. Although the increase came with an indication that officials expect to keep rates higher through next year with no reductions until 2024, the expected terminal rate was put at 5.1% according to the FOMC's dot plot of individual member expectations. There has been some speculation that might be coming down, that will be coming down potentially, or we might not even get there in terms of the Fed. Because let's think about it, right? Jesus, Jim Cramer, I don't want to see that. The Fed raised rates to, pull up the tweets here. The Fed raised rates to, what was it? Right now to half basis point to 4.5 to 4.75, I believe, percent. So if we do another 20, let's just say that we get a 25 from here, you know, and we're up to 4.75 to 5, and that's the last one, right? We don't get any more, you know, then this is going to be kind of on the low end, right? The dot plot expectations, the terminal rate. It's essentially like, are we going to get a 25 and then done? Are we done? Or are we going to get, you know, another 50, dare we say, or are we going to get a couple more 25s? Like, that's where the questions kind of lie, at least at this point in time. Okay, let's see. Highest level of Fed fund rate has seen since December 2007, just ahead of the global financial crisis. I think that's the reality. I mean, that's the concern now. Inflation's done, right? The damage is done. The whole inflation trade is over, I think, realistically. It's not over, but the reality of that is over. It's now, Fed's almost done. It's not that hard to tell. Okay, whether they're done, whether they got 25 to go, or they got 50 basis points to go from here, or even 75 in the course of a couple increments, you know, who cares, realistically? We're getting close. The question is going to be more so, how long does it stay there? And then what kind of damage should they end up leaving in their aftermath, right? That's where we're at. So the equivalent target range is from 5 to 5.25. So right now we're at 4.5 to 4.75. So they're expecting that we're going to get 50 more basis points of hikes. So if we get 225, so if we get one more 50, you know, but let's say we get a 25 and then that's it. Well, then this is technically on the high end, right? And we're going to come in lower. And from that point, and market could react to correct that, if that's currently the expectation as of now, based off of what we're seeing. So they also lowered growth targets for 2023, putting expected GDP gains at just 0.05%, barely above what would be considered a recession. So that's kind of also concerning. The GDP outlook for this year was also put at 0.0 or 0.5% in the September projections. The committee expected 0.2% growth this year and 1.2% next. The committee also raised its median anticipation of its favored core inflation measure to 4.8%, up 0.3 percentage points from the September outlook. Members slightly lowered their unemployment rate outlook for this year and bumped it a bit higher for the ensuing years. So you're kind of just seeing like a slight adjustment based off of, I guess, more data that they're getting. Unemployment has, you know, I think surprised in terms of this year. It stayed kind of low, and I think that is expected to change. Obviously, with a bit of a lag here that we've been seeing based off the hikes and stuff. All that stuff. Okay. Non-farm payrolls growing faster than expected. We saw that 263K in November, while the Atlanta Fed is tracking GDP growth of 3.2 for the fourth quarter. Retail sales grew 1.3, and we're up 8.3 on an annualized basis, indicating that consumers are so far weathering the inflation storm. We've talked about this. We really have, and it's in. By the way, SPY came actually just under 400, and then it bounced. So, I mean, if you're looking to play based off of what we have in front of us, of course, the risk is not, in my opinion, it's not worth it right now for me, because we could get Powell come on, and depending upon the statement he says initially, we could immediately be like, or we could be like, so I'm not really interested in trying to play off of this right now. However, if you had to take a guess based off of prior history, the lower we go right now, this is where you might be looking to accumulate some calls for a possible reversal back up, because we tend to see pretty good, you know, bounce back and choppiness and volatility. And the first move tends to be the false move. We got the last meeting, I believe the first move was up, and then we went down after Powell. This so far we're down. Let's see if we go up after Powell. We'll see if Powell can jump on in and almost save SPY today. I don't know if that's necessarily the way you want to think of it, but we are down. So we were actually up what was that? We're up 0.8% at one point this afternoon. Now we're down 0.62, but that volatility is, to be honest, expected anyway on this Fed meeting, baby. Let's go. Let's see. Probably mini sell-off as people are expecting a 0.25 fireworks run. I don't think people were expecting that. When we're about the 0 basis point hike got obliterated, yeah. I thought maybe, I think the consensus view was a 50. But I guess there was some after that CPI. I guess if you had to pick a side, right, what do you think, 25 or 75? I probably would say, well, if there's a better chance of one or the other, I would pick 25 than a 75 based off of that CPI yesterday, I would think. So 225s is a good shout. From this point, I think 225s makes sense. We'll see. So you don't follow Peter Schiff. I've seen the stuff from him, but I don't follow much about what I know he's like big on gold and he hates Bitcoin. That's all I know. Except the rate of inflation will the Fed succeed. I think that I have no idea the realities of where we go. I could see a scenario where we end up, not getting down to where they want. I can also see a scenario where we go and we have deflation and they have major problems and that causes a huge shit show next year in 2024, maybe even beyond. I could see both. It's at this point in time, it's going to be a gamble of what ends up happening. But it will get a lot more clear of the coming months. If this inflation keeps surprising to the downside over the next couple of months, like, yes, in theory, that's going to sound good and it's going to get us to kind of stop and maybe reverse rates faster, which like you might look at and say that's bullish for the market. But in history actually says that when the Fed makes that pivot, market still has more to go in terms of downside. It's just historical, patterns. You go back to 2008, go back to 2000, 2001, 2002 timeframe. Market still had more to go. We're getting close, though. I think you say that in terms of the end of, I guess, the bear market, which could extend, longer for sure. But just because the Fed reverses doesn't mean that we have to go up, realistically right away. There could be a couple month lag, although the market's been trying to price things in fast this year. I don't know. So there's a lot of questions, but I think if we start coming down really, really hard in terms of like into next year, the next like 6 months on the CPIs, if that's the case and we start coming down really, really hard on CPI and it becomes very apparent that we are coming down way faster than anyone thought, just like we went up way higher than anyone thought. Like if we start really blowing out, and it's going to take us a couple more months to get to that understanding. That's why the next couple months could be this weird uncertainty period where we might not maybe get, humongous, we might not get a new low or a new high, right? We might kind of just be in some sort of range for the next couple of months. But until things get more clear in terms of recession fears and like the realities of that into next year, and then did the Fed overdo it? If they overdid it, initially it might be looked as a good thing, but then all of a sudden if you got deflation, I mean, what that's going to mean is going to be higher unemployment. It's going to be more layoffs. Same thing, I guess. Companies are going to be in trouble. And so earnings are going to get crushed. I mean, you're going to have a lot more problems if you have deflation. So there's good things and bad things. Like, yes, things might be cheaper in theory. And yeah, great. But our prices won't be rising as fast. I guess that's disinflation, but deflation if things go down. Things will technically be cheaper, but at what cost? Is that going to cost your job? You know what I mean? Because your company is getting crushed too. So there's a whole plethora of scenarios. It's a really complicated situation, and I have given up, not necessarily given up on trying to guess, but like we can speculate and be prepared for a situation, but I really don't care to necessarily, set my eyes on this is what's going to happen, and I'm not going to change my thoughts. Like, what's the point? There's no point at this point in time. Tesla getting crushed, want Amazon 88. Let's take a look at some of the reactions here. So market's down 0.4. It's trying to come back off the sub 400 flush so far. Oh my, I didn't realize ELYS is up 50%. Guys, we were talking about this one, and I'll be looking at some of these guys in the next couple of weeks, especially if the market reacts positively. But look at this play. Holy sheesh. It was up to almost 40 cents today. we have a pretty good recipe for the small caps. If you want to go back to Sunday night stream, we were noticing, you can't tell because the volume today is so much more, but we were noticing there was some increase, even though this thing was going to new lows, there was some increasing volume on ELYS the past couple of weeks, and boom, it popped today. This is now the third one. The third one that we literally talked about on the Sunday stream that went. So ELYS, I didn't touch this stuff. I just not ready to do it until post-Fed, and so we'll see. SXTC, same thing, we talked about it because of volume, and then it goes from like 60 cents to almost $1 a couple days ago. And then where was the other one? It was OPGN. OPGN went 200%. There was some heavier volume on OPGN. The thing goes from 12 cents, it hits 45. Insane. So this is great in terms of looking for small cap swings. What you're looking for is just above average volume, higher relative volume. We're looking for like a two plus relative volume in a stock down near lows that has cash, that's not threatening to go bankrupt, and that has at least some time to regain compliance with the NASDAQ or with whatever exchange so that they can stay and remain listed. This has been a good play, a good strategy. So I'll be keeping an eye on some more of those, but my goodness, another one is gone. So it's potentially working, and it's worth, tossing a small portion of the portfolio, percent here or there, because when you get these 100% moves, boom, like you're even if you're going to risk 50%, or 20, 30, 40, 50%, but you get 100%. I mean, that risk reward's pretty good. So we'll see if that continues, but that's I didn't even realize. I was just checking on that today. Pretty crazy. Coinbase up 5%. Had a pretty bad day yesterday, so it's bouncing back, but still inside of yesterday's range because it had a crazy range yesterday. So the risk on names kind of mixed from what I follow. ExxonMobil's kind of weak today. Kind of mixed reviews, right, across a lot of large caps. They're kind of hanging around. AMD and NVIDIA were weak this morning, and now I'm looking at them. They're down a good bit. They're down 2%, 2.5% on AMD. NVIDIA down 1.68. Tesla, did it hit a new low there? Tesla got close, right? If it didn't hit a new low. Yeah, I think it did. It hit a new low just about like 10 minutes ago on Tesla. Let's jump back on this bad boy. On the yearly, I mean, look at that chart. That chart is nasty. But again, if you like Tesla, though, like we've been saying, like this technical breakdown could be bad. Like it could go a lot lower, right? Like it could go a lot lower. But let's say market catches a bid here and starts to push higher, and we never test the lows again, which might not, fit the thesis of everybody, right? But let's just say it happened, because what if it does? And you're like, oh man, I've been wanting to buy Tesla, but I want to buy it at $100. Well, I mean, you have a chance to get it at like, close to 150 now. If you're looking to hold it long term, I don't know. It's something that I've been thinking about or contemplating potentially to start adding into some of that. We'll see how the Fed goes today, but it doesn't look great. We're looking down towards the 150, even 140s if it keeps extending to the downside as it broke below this 167 area. So not great. Made 150 on SARK day trade. I had it today because I was not interested in playing Fed stuff or playing not Fed stuff, but just SPY and whatever, because I was expecting it to just kind of be boring until the Fed. I played ExxonMobil, played off a little bit of oil, made a few bucks on that, and that was really it. So OPGN was insane. Yeah, it was. Fed trying to play at both sides while emptying the QE book. Horrible head and shoulders. Yeah, no, it's a pretty bad one. And you would look at that chart and say it probably needs to go down more. And I wouldn't be surprised. But who knows? When it comes to a stock like that, it depends on your approach. And a lot of people in general have been pretty bullish on that thing, and they've been getting crushed so far this year, despite the market actually looking pretty strong the past couple of weeks, which is kind of funny when you think about it. But people probably getting scared now. Maybe it's a better time to start picking something up if you want to hold it long term. I don't think it's going anywhere. It might have a tough next couple of years if this recession is bad, like we talked about. Just people are not going to be willing to pay for their cars. They might have some dips in a pretty decent dip in demand. So maybe that's the opportunity. And how much of that's getting priced in now, that's the question to ask. But maybe that's an opportunity if you think about it. Elon has a lot of bad rides right now. Tesla needs to prove itself once. Yeah, he even said on Twitter, I believe today or yesterday, that Tesla shareholders will benefit in some way from the Twitter fiasco. So I don't know what that means, but he said that's what he said. Twitter's killing his image. It seems like it for now, at least in terms of like People are, I guess the thought is it's taking away from Tesla, right? And so that's why. But let's do a sound check. Let me know in the chat how this sounds. If it's too loud, not loud enough. Let's put some no copyright music on. Of course it stops. I caught it like during like a break. Let's just like fast forward here. Yeah, how does it sound? What I'll do, okay, I'll mute it now. What I'll do for the Fed press conference is I'll mute myself so there's no like weird extra mic stuff because I have my speakers playing so I can hear it too because I actually want to hear what Powell says. I'll mute myself and then I'll come off mute from time to time, bouncing back and forth, but sounds good. Okay, good. And maybe Powell could be lower so we can adjust. I can adjust things too once he comes on, but hopefully as long as it works. That's some, for whatever reason, we've had problems with the sound in the past. So as long as it works, we're good. The sound is good. Awesome. Thoughts on new cars and the new way of monthly paying options on cars per month. Yeah, I mean, I think we were talking about this. I forget a couple of days ago. I feel like we were talking more so about price of EVs and that the problem that we're going to have, especially into a recession, is when it comes to EVs, they're still just a little too expensive for most people. So especially if we are in a recession, people are going to be, I feel like, much less inclined to want to go the EV route and pay the premium when they could go get that used, not necessarily Prius, but used Camry, like used Corolla, used Civic, you know what I mean? And because that used car market's getting crushed right now. So top high-end cars got crushed first, and now it's kind of bleeding out. And the low-end cars, but the more affordable cars never end up getting, they're getting hit, but they're not going to get hit as much in terms of a percentage-wise than the high-end, because there's always a demand for the lower end or the cheaper cars in terms of used car market. But I myself am someone who's going to be in the market next year for something. So we're going to see, what I want to potentially do. And I guess the timing is pretty good, ideally, right? That it's coming. I'm going to be in the market for one next year. But I do think that there's a lot of interesting kind of components to how the new payment situations in terms of, at least Tesla, I feel like is at a pretty good forefront of a lot of that stuff. And so the only problem I have with Tesla though is, again, it's still on the higher end of what I feel like people are willing to pay, especially maybe into next year. And that's like the biggest thing. But in Musk we trust. He always comes through. And you can't bet against the guy. I mean, he's been on fire in a lot of ways the past couple of years, right? So if you've been betting against him, you probably are losing generally, unless you're timing it up pretty well. 2021 Sonata Limited Hybrid. I love the gas mileage. Gets a consistent 52. That's pretty nice. Pretty nice. I've been going back and forth between am I going to lease or am I going to buy used? I don't know. I have no idea what I'm going to do yet, but we shall see how things play out the next 3 to 6 months. Probably sometime, that's like the time frame I'm looking at. If things get really bad and just prices are plummeting, I'll try to push it off as far as I can, but I was looking at, I think in terms of like cheaper leases, Hyundai Elantras are pretty cheap if I'm not mistaken. And they don't look too bad. I want to say Chevy Blazers. The Chevy Blazers were pretty cheap, or they're relatively cheap leases. I was looking through a couple lists of a couple things. Buy used. Okay. I feel like in the future, depending upon what my intentions are, I don't really know how much I'm going to need it necessarily, but we're going to see, because I'm moving and we're going to see how things go. We have one car, but we might need to get a second. That's the whole point. So we're going to see how the next couple months go, and if it can be done, and if it can't, then we'll have to buy one. I bought a used back. My first car was a 2003 Nissan Xterra. Those were the days back in high school when I bought that for $4,000. I'm sure that thing probably, who knows where that thing is now. But I bought it for $4,000, used it for a couple of years, sold it for like $1,600. Thing was like essentially a piece of crap. Check engine lights and just never turned off. I just drove it, never had a problem, but I used to have 100. I used to have a launcher and loved it. Yeah, I mean, I just have been seeing from lease, at least from a lease perspective though. Haven't looked in terms of used. It seems pretty cheap, and it seems like a decent car. Depends on your needs, but all right. So the sound was good. Let's cut that off. Let's see. Press conference is coming up in about 7 minutes. So we got that. Let's just check on tomorrow. What do we got for tomorrow? Tomorrow, economic data. We've got jobless claims in the morning. So keep an eye on that. 8:30 a.m. tomorrow, prior to the market open. There's going to be some data coming out. So let's see what happens off of this too, right? Just make sure you're paying attention to that, especially after today's move. I'm assuming it's going to be a pretty big move. But this could be something that changes that. So straddle not doing too bad. My situation is I have my straddle, right? My strangle. And I have essentially, I am right in between, like direct smack dab in the middle of the two options that I have right now. So it's not doing well for me, although I have until Friday. So we'll see. But I need SPY to make about a $15 move in the upper downward direction from here. I don't care which way. I really don't. And then I'll be able to come out green. But it needs to kind of do that ideally today or tomorrow. Well, it could happen Friday, but it needs to kind of at least make its start to that move at some point here. At some point here soon. So I'm curious if you were to, let's just say, if you were to play off of the recent volatility in these FOMC announcements and the Fed meeting and Powell's meetings, we haven't had too much volatility here. I mean, we have just dumped. We haven't had back and forth, and now we're just consolidating here right around 400 prior to Powell coming out and speaking. So are we going to just get the same situation where we kind of have, choppiness? First move is the false move, and we end up at reversing back up and then squeezing out today? Are we going to get this? Or are we going to kind of break the pattern and just dump? This pattern has been pretty consistent, I would say. Or dare I even say, Powell comes on, pops it up, and then we fade back off, adding a little bit extra trickery to the move here. At some point, like we've been saying, at some point we're going to get one of these FOMCs that move and they never reverse, and it destroys everybody because everyone's expecting a reversal. At some point, it's going to happen, but maybe it's today, maybe it's not. Maybe the string was a little too hard. Yeah, I mean, it kind of was. I just didn't want to play it closer. It was a little more expensive. I wasn't willing to pay whatever I paid for it. Wasn't trying to play with this too big of a bet. It was like a $500 or $600 strangle. So I didn't want to do more than that, to be honest, in case it was a total dud, right? I need TQs at 27. Let's see where the TQs are at. We got still 4 minutes to go until 21. What's the trend? This has been weak, which is kind of funny. If you look around, I was just looking around at other markets across the world. They've actually done pretty well. They've bounced back pretty substantially. So I'm really wondering if we are maybe lagging, other markets. I really am. It's interesting to think about. But TQs, I mean, hey, it's been holding this $20, Well, I guess, Qs have been holding the 50 SMA, so TQs are doing something similar. But back to that SPY. It's just pinned right at $400 on SPY. Doesn't want to move. Doesn't want to move. But it also kind of looks like to me, or if you just kind of zoom this guy in, what do we got? Looks like a bear flag, right? If we didn't know, if I saw this pattern setting up on an intraday stock, right, I would say to myself, what would I do here? I would probably play it short, have a stop loss somewhere at like 401, and then looking for continuation to a new low. That's what I would do if I didn't know that we had Powell speaking in 3 minutes. So let's see what ends. It's going to be fun to see what happens at a minimum. All right, we are 3 minutes out, a little bit less than 3 minutes out, and then we'll run it to the close. I am probably not interested in trading anything unless we had a very clear direction, and then it's kind of obvious. But probably not. I had an ExxonMobil put play that I put this morning, which ended up working out really nice. So I'll kind of cover it really quick. ExxonMobil, I had it right here. So, this is the trade idea was still there. I ended up getting in somewhere right around this entry, or this area right here. Why? Was because oil was pushing up. oil was actually way higher than where it was yesterday, but Exxon popped at the open and then got rejected pretty hard. So my stop loss was like, okay, oil's strong, Exxon's not. Let's see if this weakness is going to hold. And that had me kind of thinking, okay, we kind of got yesterday's highs as resistance as well. This thing has bounced back a good bit. I just don't think that well, I want to say I don't think. We're kind of up into the resistance, a couple of these wicks that we had as support right here. So we had resistance there, and I had a pretty nice tight stop to it. So I took a shot at it. Also, with oil being strong and Exxon was not, any dip in oil was going to show weakness. And we got a pretty big dip in oil, and then that killed Exxon. And we got a pretty big move down. So it ended up hitting my targets I would say pretty fast. It was like, a 45-minute trade maybe. And I moved on after that. That was it. Pretty much. So that was what there's no need to touch more. I mean, this week I've been green every day. So I've been building back, and, I'm not going to try to force that or lose, essentially what I did last time Powell spoke. I am not trying to do that, which I did not think that it wasn't an FOMC. It was a random kind of Powell speech deal or speaking event. And I was like, all right, I'm not expecting much volatility here. I'll play for continuation downside. We got the exact opposite. We had one of the biggest up days in the past couple of weeks. So not gonna do that again. In between this live stream in France, Morocco. Yeah, no, I kind of wish I was watching that, but I got it pulled up at least score wise on my monitor. France is up 1-0. I really don't see Morocco having a shot here, but who knows? Something crazy happens. It'd be cool to see. But France, Argentina will be probably a pretty good game, you would think, in the finals. All right. Let's see. Powell coming up soon. I'll have it set here, and we'll see. SPY's at 400. We'll kind of jump. We can go back and forth between SPY and Powell if there's some notable moves. But I want to make sure we at least. Here he is. Let me know the volume. Check the volume. If it's good, bad. I just unmuted it, so we should be good to go. Comments are turned off. It's funny, from the Federal Reserve. Should be seeing Powell any minute, and getting some volatility, baby. SPY just sitting though at like $400. So SPY is just pinned at 400, and we want something more. I'm really hopeful, because if we get a nice, move up or down, there's going to be a lot of better setups to take advantage of, and it should in theory be pretty big, because we've been consolidating for a little over a month. We've been just consolidating. We haven't broken a nice range, so this could give us some more direction. Here he comes. Check the volume too when he starts talking. Oh, there he is. Let me know if it sounds good.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time.
Since he's come on. It hasn't moved.
I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance
Now she's
over
dumping
time,
here. New low on
easing
SPY.
upward pressures on
New low. I'm going to have to
wages
adjust
and
the
prices.
chart because we're going down so much.
The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing, It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
All right, so there you go. So he came down
Steve
396.30.
CNBC. Thanks for taking my question.
A little
Mr.
bounce
Chairman.
there. I
Can you just
took
talk
a
about
small
the
call with a
importance
third of today's profits.
Market conditions reflecting the policy restraint you put in place.
See if it holds.
Since
If
the
it doesn't hold,
November
I'll be
meeting, the
out.
10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more.
So it's
in the
interesting,
fives.
really quick.
So that's our best
Essentially,
assessment today.
the first
for what we
question
think the peak rate will be.
was that blatant
You will also
question
know
that
at
the guy was
each
like,
subsequent
essentially, do you think the stock
SEP
market
during the
going
course
up is
of this
good?
year, we've
you know?
actually increased our estimate of what that peak rate will be. And today, the SEP that were published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina. Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question.
Market's
But I
bouncing.
would say
400, we're back to 400 now.
is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy, and that'll be the key thing. But I mean, but for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. It's the biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed? Well,
I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself.
Market doesn't like
Generally,
that one either.
Companies want to hold on
Still
to the
holding
workers they have
397 for
because
now,
it's
though.
been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Temeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Makes sense. Take a quick bathroom break. I'll be right back.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is
I think
our
it's ripping
policies
back
end
up.
up
We're almost
getting
testing
into a
VWAP.
pretty good place now.
400
We're restrictive,
testing, we'll see what happens
and I
here.
think we're getting
Breaking
close
above
to that
yesterday's
level
lows.
of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get
VIX has been dumping since
and,
Powell. That's the
I mean,
big
it
thing.
boils
VIX
down
is
to
now
how
under
long do we
22.
think this
It was up
process is
over
gonna take?
23.
And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that. under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring that?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't. Talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
That'll do it. That will do it. Let me adjust my speakers here. Kill that. Boom, boom. Well, here we are. So, after all that, to be honest, today I would say is one of the, we had some volatility, but it's not as crazy as we've seen in the past. We've had some much crazier days in terms of the market. So, let me just adjust everything, make sure we're all good to go. Let's see where we finish up, but to be honest, I think we kind of expected maybe some more volatility, more direction, because we still are right in between this stupid range that we've been trading in like the past month. So we need, again, like we've been saying, a break of 410 up or a break below 390, and we have yet to get it. So right now we sit at 401.25. If you played off of today, the call, VIX has gotten killed, but we'll see how it finishes the day. Off of this 396.30 low, it had a nice reversal up, but the VIX in the meantime has been getting killed. So it's kind of minimized the upside you've been potentially seeing on certain options if you played options. So it hasn't really been too crazy, really, you know. Believe it or not. Santarelli, I will see if this holds up. Let's see if it handles the VWAP and how it handles this. If it holds the VWAP, you know, maybe we get a push into the close. But it seems like, I mean, if we get above this 405, oh yeah, we could easily squeeze out into the close and go up to yesterday's highs. You know, maybe not right away, but maybe into tomorrow or something like that. But we didn't get that. And we didn't really break down below 396. So here we are just in between. And what we may actually just see this, and then maybe this changes tomorrow, because I think a lot of people may have been playing today's expiration options. A way to kill both sides, just to crush volatility and kill both sides. You know, puts lose, calls lose if we end up just in between, right? We didn't really move that much. So maybe the strangle idea, or it depends upon how you're playing them, but maybe that idea for this week ends up burning a lot of people if this is where we end up. So we'll see if this actually holds here, but we're kind of flat on the day. You know, we're only down 0.25% roughly. So we'll see. A lot of price action. It was doable. Long call. Condor would have done well if you had gotten yesterday. We'll see. I mean, we'll see how this. It's kind of holding up over this level right here. 400 is kind of holding now as your support. So we'll see if it holds above 400. If so, cool. If not, we'll check out other stuff. So VIX is at 2150 or so right now. It's come down a lot. It was at 2350 at the beginning of Powell's speech. The 10-year spiked to 3.56. Now it's back to 3.48. Spiked to over 104. Now it's back down to 103.50s now. Put call ratio, a lot of puts on that Powell speech. So seems like that's been kind of coming down. I mean, a lot of puts. I mean, it's been coming down to more calls, but it spiked about 1.425. So puts loaded up. I mean, if that was just more so just intraday puts, intraday options versus if that was, you know, maybe this more looking out bigger picture. I don't know. But it's trending back towards calls a little bit. But that's, I guess, if you're looking for more fuel for a squeeze, you know, that's helpful. So again, like we said, if we get over high of the day, which it's not that far off, it's like $4. If we got there, then you probably have a nice squeeze into the close. It just doesn't look like we're probably going to get that, which is kind of a shame because we didn't get the downside that we kind of were looking for, you know, down towards the lows of last week or, you know, even the lows of Monday. We're not even there. It's like, come on. It's not an easy situation, it seems like. Still. But I mean, Powell, to be honest, nothing unexpected there. Really, there was nothing unexpected. He got a couple good questions, but nothing too crazy. No one did anything stupid. He didn't really seem to care much about. And he had the question about the market early on, about how based off the market and, you know, bonds and yields and stocks, you know, it seems like financial conditions have loosened a bit. But even that, though, he didn't really care. He didn't really seem to react too strongly in a direction for that. So it didn't seem like there was much bias in his movement. So it was kind of I don't want to say a nothing burger, but it almost feels like that. Nothing crazy came out of it. Straddle work both times. Gotta be quick. In terms of, if you got out off after the nice move, yeah. But I mean, for example, the call that I bought, now it's this Friday expiration, so you know you're playing with fire. I didn't play a same day, but you're still playing with a couple days out to expiration. I bought it at around 398, right? It was cheap. It still is cheap, and it's technically down. I'm technically I'm still holding it. It's technically red because it can go to zero. I don't really care. I played it with a third of my profits for today, which was fine. I'll still close it out for some value, but it could go to zero and it wouldn't really piss me off. But we're here. We are now like 3 points higher, $3 higher on SPY, and it's red. Barely, but it's red. So the VIX got crushed. So that's kind of what happened the past, hour and a half. VIX got crushed, and here's the VIX. That was a move right off the highs. I think this is technically a delayed VIX, but it's still sitting around that level. It's actually down maybe a little bit lower. But VIX daily chart, we had this level around, what is the level? This level is like 2230-ish. It's kind of a level of interest, support, kind of resistance, and now we're back below it. So to me, that doesn't look great. If the VIX gets back over 22, back over 2250, that's more concerning for the VIX. But we've seen this story, happen again. It seems like after big events, after Powell, after CPIs, the VIX just after these big events, it pops prior and then it just bleeds out. And so if that's the case, we could just bleed the VIX out. It doesn't mean the market has to go to highs, but the VIX could just bleed out, back under 20 for all we know in the next couple of weeks, days/weeks. Could be even if the market rips higher. Obviously, it could happen in days, but if the market doesn't really move, it might not be as fast, and it just kind of might bleed out slow. Dollar was right back to where it was before we all started. Yeah. I mean, it just seems like I want to say nothing burger, but it's like a nothing burger almost. It's like pretty boring. I mean, you would expect a big move. We really did, but maybe it comes to finish off the week, because when it happens, it's going to be pretty aggressive, I would think, up or down, right? Today's volume on SPY is getting up. It's gonna be pretty high. It's gonna be up there. Maybe not as high as yesterday, but it's gonna be. It depends on the close is. It's in line with how it's where volume's been the ppast couple of weeks on average. So we should have a nice higher than average day, I would imagine, since the past couple of weeks in terms of volume. But we're at 401, 40 something, 45-ish, 25, bouncing around. But it's like just barely red, but on the day. But even though, I guess, big picture in terms of constructiveness and how we're looking overall, I mean, we're technically still high. We're pushing higher from where we were to finish off last week when things didn't look great, and we're down around 393. We're still we're almost $10 higher on SPY. So it hasn't been in aggressive fashion, but it's been of course, there's been a lot of ups and downs along the way, but it's been kind of slow and steady in terms of higher lows, if there's something to take away, right? So that's the biggest takeaway, at least it seems like for right now. Outside of that, I'm just going to check. I bought a UVXY put for next week. Small, but we'll see. It seems like market's trying to hold up and VIX is getting hit. As long as it stays under 22, I'm fine staying that. So I'm just going to leave that for now. And that's it. I played it in the small account. So we'll see how the Roth does. I had a small green trade in the small account today. I had a red trade yesterday. The problem that I have is that I've been playing off the other account more because it's a larger one. So I'm like, it's more meaningful. And I kind of just like don't trade the small account as much, which I should honestly just take the same trades in both and then just, play it out that way. But I don't do that all the time. Really ever use limit orders in and out with hotkeys, never have to worry about typing. That's not a bad idea. I don't like it personally for the style that I like to use, but people who like, who use them and like them and have a need for them, you almost like never look back from what I have seen and heard. There you go, SPY. Now she's going to come down. Look at that. We'll see if we hold yesterday's lows around 399 or so, but just chipping, chopping away. Hopefully, though, either way, right, whatever happens today, hopefully we get a better move. It's as sucky as it sounds. Am I going to wait till tomorrow? We got to wait till tomorrow now for something? Hopefully we get a much more clarity on something tomorrow. Now the VIX is coming down. At least, does it have to stay down? No, but VIX is coming down relative. We'll see if it continues to come down. Bigger picture. And, some of the more questionable or interesting events are behind us. We got the CPI behind us. Powell's done. That's behind us. Some of these events are behind us, and now we can kind of just trade, and momentum will take us where momentum takes us at this point in time. So we'll see. But we'll see. Market will boom tomorrow. All great news settle. I wouldn't be surprised. I wouldn't. And it's kind of how, to be honest, this week is kind of gone, because if we're going to dump and we're going to roll over, well, it starts off kind of slow, then it accelerates. But to be honest, we've actually look at the daily chart and SPY. We've been just holding these lows. We've been just holding higher lows. We're still holding the uptrend. The uptrend is still intact. The downtrend had a test, we had a false breakout yesterday, technically off the open. So that's what's in question now. But we've actually been holding this uptrend since October. So we'll see if that's still holding. And under 396 is the bottom of that uptrend. So, under that, really 395. That goes, then we can kind of break this downside and maybe test down towards 380s, have a bigger move down. But if it does not go and we just kind of hold, right, now what? It's just going to be kind of like, all right, we're just kind of chilling and we're holding this uptrend. All right. So it's slowly but surely it's going to be hurting those in puts, because if you're buying puts and you're going short, right, the higher we go, obviously you're down, but also the more time that goes on, the VIX comes down, those are burning your contracts as well. So it's just taking its sweet time. But look at this range though. We have talk about a range, right? It's like the megaphone look, right? Where you have it extending towards the ends. We haven't really come down towards the bottom. We got to the bottom end, I guess, a couple of days ago, but it's almost like a megaphone pattern. And a lot of people have been seeing stuff on Twitter. They're like, oh, megaphone patterns. Here's how they work, right? You got to move up or whatever. And then you got your megaphone. And then you got like a big, consolidation. And then they just go like this. They just draw the lines in. I mean, sure, anything can happen, right? Anything can happen at this point in time. Gonna watch the rest of the game. Catch y'all soon. It was fun. Hopefully we'll be back. Actually, no, I'm moving on Friday, so I will not be back Friday, unfortunately. But I'll be back Sunday night. We'll do a stream, and then next week we'll be back to kind of normal. So, peace out. Enjoy the game. Hopefully, there's some more action there than here. It's 1-0 France, but hopefully maybe we get a little extra time action. Morocco puts something through. We'll see. We shall see. Read much more calls. Expire this Friday. Then puts, not sure if true. Interesting. In terms of where more people are buying in terms of expirations, I wouldn't be surprised. Wouldn't be surprised. Man, this is gonna be sucky if we don't end up with a trend break into the end of the week. Broadening wedge, something like that. Yeah, that's what it looks like. SPY coming back on down. Looks like, that option that I bought essentially is going to be a dud. Even though it's still technically higher than where I bought it. I was green a little bit, but like the VIX was coming down so hard that it essentially killed the contract. I bought a pretty far out the money contract. Essentially killed it. And we didn't move. We really didn't move as much as I thought we could move. But whatever. Peace out, August. Enjoy the day. We've got 30 minutes left. We'll run it to the close. And then we'll cut off there. Maybe we're going to get a dump. Maybe we're going to get a dump here. Are we going to get a dump? Wow, look at this. She's dumping. We fell below VWAP, and now she's coming back down under 400. If that 396 breaks, we could accelerate downside, at least into the close, maybe. And then tomorrow's a whole other ball game. Whole other ball game. But let's see what happens around this area. This is the closing of Monday. Monday's close is like right around this level right here where we're sitting at right now. Let's see what happens. Zero day to expiration SPY. IV was so high earlier. Yeah, the best way I guess the way to play that was to capitalize off of that. You know what I mean? You could have played some spreads, depending on how you played it. You could have played spreads and whatnot to play off of that. And as the VIX takes a hit, or as the VIX took a hit, now it's catching back. It's coming back up a little bit. It's back up to 22 roughly. There was opportunity there. Let's see. Is this going to actually give us a move here? Maybe downside? My puts, my strangle puts are 390 strikes. So I need a big move down. We could get it to the end of the week. We could, but we need something. Dollar surging again. DXY popping back up off the lows. Interesting. It's kind of in line with SPY. The dollar and SPY have been a good inverse, generally speaking. Eddie's in the house. I don't know. Trying to think too much about the reasoning why is honestly not, in my view, not worth it. It's big picture macro, I guess. It's important, but in terms of today's price action, who knows, man? I mean, really, one of the biggest things that I have taken away from the legend, I guess, Mark Douglas in terms of trading, is that a lot of times short-term moves are disguised with news, when in reality, it's just bigger market participants that are moving. The ones who have the power to move price are the ones that are moving price. And to be honest, it doesn't, those are just a cover. Like sometimes the news and trying to spin a reason as to why this happened, why that happened, is just a cover for price action and bigger picture participants. So I try to in reality, we have catalysts. I try to think of it more these days as catalysts to give us moves and to give us, direction, and the next kind of momentum-based push. But trying to think too much. I mean, the 50 basis points was expected. I think the Fed came out with more so a push to see rates higher and longer. That's kind of been the progression, that the rates are going to be higher and longer, and they're going to stay there longer. And that's like the big picture. And that's kind of what Powell reiterated, but even that, not a humongous change. Nothing like that's, to be honest, super unexpected. We kind of knew that. So it seems like on the inflation front, you give us 2 more months, 3 more months of CPI coming in well below expectations, right? And we keep going on that trajectory, then that starts to change his mind. He didn't seem to care because he was kind of more like, great. Like we kind of need that to happen. Like CPI needs to come down. We kind of need that to happen, right? So that's kind of like my takeaway from it. I don't want to think, I'm not trying to think too much about, why we're selling off because we got a 50 and versus, a 75 or a 25 or this or that. Nothing super unexpected came from it. You would think what we're kind of getting is a VIX coming down since past couple of days, since like Tuesday. VIX is coming down off the CPI. That's the biggest takeaway, I think, is the VIX is getting hit, and we're bleeding contracts. So people trying to play off the volatility are getting bled out. We're bleeding out of, short-term expiration contracts, and market's trying to stabilize, and it might just chill for a bit until it's ready for the next leg, whether it's up or down. Yeah, these calls, man. I mean, they were bought essentially, right? They were bought essentially right here, and we're at that same price. Yet they are down 68%. Out the money spies. Not for today, for Friday. But they were, geez. I mean, that's just VIX crushing. Volatility crush. That's what it is. So we'll see what happens into the close. We're still down. Well, we're now down about 0.9. Almost down. We were down about 1% a few seconds ago. We were up 0.7, 0.8 before Powell. We got, and to be honest, this is actually, we got a reversal, but unless you scalped or were in and out pretty quick, we didn't really get the same type of reaction that we've gotten in past FOMCs, because we kind of would get the first move as a false, and then we get a bigger move up, and then that bigger move, that reversal move tends to, go hard into the close. And we've kind of didn't get that. Like we had this move down off the initial reaction. It went down lower. Powell started talking, and mid-speech it went up, or towards the end of his speech it went up to 403.50, and now it's just reversed back down to the downside. So we're getting kind of the opposite of of what we've gotten in the past, and that maybe this is that situation to blow out traders who have been playing specifically off of some of this volatility and off of the recent correlations and the trends that we've been seeing with the recent FOMCs. Maybe. I don't know. Seems like it's possible. I have a UVXY put that I just snagged. It's down like 5%, but I'm gonna see if that plays out as long as VIX stays under what is that, 2250. I'm gonna see if that plays out. It's small. Tons of whales buying S&P calls came in yesterday during CPI. Maybe a bigger move comes tomorrow Friday. I think that's the case. I think so. A lot of people playing, especially the surge in I'm not sure. I've seen some charts over the past couple months. I don't play them. I know Flippa plays them though. The 0-day options, but a lot of people. There's been a pretty big surge in just directional bets, right? Now I think you were playing some straddles for today, right? 0 days. I'm not sure if you played 0 days or Fridays or whatever, but either way, right? If you were in and out quick, it doesn't matter. But there's been a big surge in people playing directional 0-day option bets. And nothing, fine, right? Whatever people want to do, you do what you want to do. But I think people are playing those and getting them, and especially they're having a field day on CPI days. And so, give us CPI and FOMC days, because we get these big moves, and give us a day where maybe we don't get a big move and we kind of have a small relative move where we end up closing maybe flat on the day, but everyone's expecting so much volatility. What is it going to do? It's going to, that's your way to wipe out people playing these options. So it's kind of what you're seeing. At least it feels like that. The name of the trading indicator on the side for volume, I have VRVP. Yeah, mine is visible range volume profile. I just customize the settings to make them all white. Yeah, let me just pull it up. VRVP, and we go to my settings. I have the inputs at ticks per row size 50, volume total, area 100, and then style. I have point of control, and then I turn my value area up and value area down to the white color, just because I just like it all looking the same color. I don't need to have different colors. So I've customized it a bit, but that's what it is. Ever since they added 0 day to X on SPY and Qs, they bust open the casino doors. Yeah. If you're quick, you could do very well. It's fine. It just, as long as your risk is in line, and it adds a different layer of fun to the mix. But what would just be hilarious is that, we got this behind us. Maybe tomorrow's a better day, but we end up with, we go tomorrow and we're just like, we're just shopping around $400 on SPY. It would suck, but maybe the next week is the week, So we'll see. We will see. My phone stand rubber thing just fell off. Jeez. But VIX is at 22. I'm thinking that the VIX is going to be the cleaner play versus SPY calls. I think the VIX, a downside VIX, if it stays under like 2250, that's kind of a nice looking spot. If that's the case for the next couple of days, and we don't break down under 395, 390 on SPY, I think the VIX could be a decent fader. For straddles, I use December 16th. Okay, TQs and December 16th. UPRO, IV on the 0 days is way too high. Okay. That makes sense. Mine is getting crushed though, right? What is mine? My strangle is now worth $1.18. It's down 80% or 79% on a total return basis. But it is what it is. It's not over. I mean, if we get a big move tomorrow or Friday, and it can come back from the dead. But essentially, it did exactly what it couldn't do, or what you didn't want it to do, to make money. And this is the one that the market just goes, yep, volatility sucks. We're going to keep it right in between. We're not going to give you a directional move this week. So I think about this, though, from those who have been looking for some more action. When the doors open up and they finally let this thing go, we're going to get a big move when one of these trends, bigger picture, when one of these trends breaks, right? The downtrend breaks or the uptrend breaks, we're going to get a big move, and it should be really fun. So, there's no reason to try to force stuff and, get a little chop. You're going to get chopped, right? You're going to get chopped up, and there's actually an indicator on TradingView. It's funny enough. It's called the chop indicator. Check this out. See if I can find it. It's called the chop zone. Look at this. So on the bottom of our screen, it's called the chop zone. And what it tells you on different time frames, if we're in yellow, we're in chop. If we're in red, we're in downtrend. If we're in this like greenish blue, we're in uptrend. And it kind of, as of late, it's been more green-blue, right? Even though we've kind of been choppy, as much as crazy as it sounds. But what that just kind of tells me, big picture, is that like when you broaden it out to the daily chart, we still haven't necessarily lost the uptrend. So there's still that. We're holding up higher lows and still kind of uptrending, even as choppy as it is. Now you go into like this, let's go to like 3-month chart, and what you're going to see is that it's been a lot more choppy, right? It's not as clear and consistent. It's been a lot more choppy as of late. So the quick shifts from red to blue to red to green to blue, yellow, and like that's just telling you we got Chop City. Chop City. By the way, though, these are the chart prime bearish engulfing, bullish engulfing indicators. They seemingly have worked decently the past couple of months since July. There's a lot of bullish engulfing, or bullish candlestick patterns being indicated towards relative lows. Not all work, Like this one right here didn't really work. And then these bearish engulfings or these bearish indicators are up towards highs, which actually worked out pretty well looking back. So it's been kind of cool. Just another visual, I guess, on the charts. Just another extra set of eyes is how I like to look at it. Oh, they've worked. They can, yeah, because you could lose if it just pins right in the middle, of your or of the prices. Or right, let's say you bought a SPY 400 call, 400 put, and we don't really move much, and you're in this like tight range or whatever, and you could lose the whole thing, like, depending upon your time horizon and stuff like that. So you gotta be careful. You do, but certain times they work, and I feel like for these types of events, generally speaking, they will work pretty well. It's just more so after we've had some crazy volatility off of these events for many, many times in a row. You kind of know it's coming at some point. We're going to have a day where the market's like, I'm just going to take your money because we're going to let this expire in between of range, right? Because it gets to the point where a lot of people are playing both sides. And so they take your money, you stop doing it, and then the next time it happens and you get a big move, So the strategy is not going to always work. You have to understand that there will be times where this happens, and then there'll be times where we get massive, like the past, massive moves off of these events. So, some are going to win, some are going to lose. Ideally, you find a strategy that where more win than lose, and you stick with it over time and let time do its thing and let the statistics do their thing over time. And who cares? Chop index can be very valuable for 0 days. Yeah, I think that's it. Really, all I liked. I mean, I don't look at it too much, but from the times I've looked at it, it's more so, what are we in right now, right? So when you look at the big picture on SPY, like we're technically, we're uptrending, and that's true. We are. So trying to force downside here, hasn't really worked. And big picture, if let's say you're on the short-term time frames and it's chopping, and we're going to yell a lot of yellow, or we're going back and forth between green and red, and it's not a lot of consistent blocks of big chunks of moves. It might not be a terrible idea to just relax and not be as aggressive and size down or whatever you want to do. That's what the use case to me is. It's more so for that purpose versus trying to force moves and this and that. So we shall see. 45 minutes until close. Let's see if we go out to next month or next Fed meeting, whenever that is. Let's see. When is that going to be? 48 days, almost 2 months, month and a half. Next meeting is February 1st. So we're looking at a 58% chance of a 25, it looks like, a 35% chance of a 50, and a 5% chance of a 75. For next Fed meeting. Interesting. Very interesting. A day ago, so this has shifted in a big way. Today, to a higher percentage chance that we're going to see a 25 versus a 50. In the past day, that's been the shift. Interesting. Very interesting. Not surprised. But that's the shift in that, I guess I won't say indicator, but in the projections for the Fed funds rate for the next Fed meeting. I guess I can't really say that's surprising to me. Let's see what we get to the close here. Do we get a red finish? It looks like we're probably going to get a red finish unless by Rip's face. It's got to go $2.50 to go green. I don't think that's going to happen. In 15 minutes? It could, but I don't know. And then we set the stage for tomorrow, back at the same place we started today. As fun as that sounds. But I would expect, overnight, we'll, watch futures. It could be interesting. Not that you need to get that same relationship that I used to have in the past where I would be waking up at 2 a.m. and checking futures, which is just horrible for your sleep and mental. I don't do that anymore. Ever since I started going all cash every night. I'm on the Webull accounts. I don't care. I sleep much better, which is good. But, watch them tonight, before you go to bed, check them and just maybe get a feel for where the directional pull is. Because it could be interesting to see how that plays out. And maybe after the close, into tonight's futures and stuff, the market starts to really digest things and just kind of like, melt its way up or down, right, in that direction that it wants to go. And then I would think that tomorrow and Friday we get a bit better continuation move in whatever direction it's going to be. Will be the catalyst to break out of this range. I don't think that we necessarily need a new one. I think this is, we have what we've got, and we could just kind of bleed out of this range, as we push to whatever direction, or that 390 or that 410, as we get there, and if we finally get a break of that range and it moves, then that will accelerate the volume, and I would imagine, that's what we're going to see. And we'll get that acceleration once we break. Because again, if we break 410, and there's a good chance we're going 420, 425, 430-ish on a squeeze out, because that will be a technical breakout, and you're going to have a lot of people who have been looking to be short, have gone short or whatever, rethink their thought process and say, you know what, I gotta stop myself out here. I can't just sit on this and get blown out on the short side, because maybe I think we go lower, but let this thing blow shorts out and then I could re-enter. And whether that re-entry is a good entry or not, who knows, and we'll cross that bridge if and when we get there. But I think that that's the look. Same thing with the dip buyers, right? If we break this trend line, we broke this uptrend we've been seeing on SPY, and we start to accelerate to the downside, we start falling under 390, we start going back 380s, fill this gap back down to low 380s. People on the long side, as we start to crack down below 390, are going to start saying, yeah, you know what, I'm going to just step out here for a second, not for a second, for a bit. I can re-enter long if I want to in the future, but I'm going to step out, and I don't want to get caught up in potentially a bigger move down if this is rolling over for a potential bigger move to the downside, dare we say to new lows. Not really sure I want to be involved in that, and so the people probably step out, and so we'll probably get some better action. So I think that there'll still be some moves. It's just maybe it just doesn't come when we thought it was going to come. So that's where we're at. I think it's going to be fun to see what happens. Very fun. Because I don't think it's going to be in this range. We're not going to be in this range forever. When it breaks, it'll be pretty big. Oh yeah, did you guys see? I filmed it because I figured it was worthwhile to talk about. At least give my thoughts on it. The penny stock guys, the pump guys. See if we can pull it up, my history. Don't worry, I got nothing bad on this history. You guys can look. You can look at it. You can screenshot it if you want. I don't think there's anything bad here. No, it's all fine. No, but this right here was. I guess I can pull up the. Do I have the link? I don't have the link off the top of my head here, but I have this. Do you guys see this? I posted it up in the Discord, but check this out. All these guys, big Twitter guys. Zach Morris, PJ Matlock, Tommy Coops, Mystic Mac, Hugh Henney, Laid Back, Didia Dips, Ultra Calls. SEC's coming after them on a $100 million stock manipulation situation from what they did in 2020 and 2021. Pretty nasty stuff. I had that on Friday. I'll post it on Friday because I figured it was worthwhile or maybe tomorrow. It was worthwhile talking about. But yeah, I mean, some dirty shit, honestly, just to be blatantly honest about it. It's the funniest thing that came from it. Let me get rid of this Powell thing. We don't need that anymore. Was essentially these guys did exactly what a lot of people suspected in terms of pumping and dumping, but like pretty bad. Like in terms of like CEI, like some of these guys were calling for, 3+ on CEI, calling for this, calling for that on some of these stocks. And what they would do is like, and they have, voice recordings, they've got messages, they've got all this stuff. And they've got the timestamps of when they bought and sold from their brokers. I would imagine that's what the SEC got a hold of. And the thing, the FBI is involved now too. And it's pretty messed. They got, I mean, who knows how bad, but like I think up to 25 years in prison is like on the potential top end of the range. Like it's nasty. I think I was reading through one of them. It was like for CEI, it was like they were pumping. They loaded CEI at like 46 cents, and then for like 2 days, they all had accumulated shares at an average there. Then what happened was the next day they came out and started pumping CEI in the power hour session late in the day, and they started pumping CEI to potentially get a little bit of an after hours volume push, which then tends to lead into potentially a big push up in the after hours and could be an overnight gapper. So there's reasoning why. But when they realized it wasn't making as big of a move that they wanted, they all sold it while saying that they're going to swing. This is just one example. There's a million other examples that they had in there that they have these guys like with literal evidence screwed on. I just don't know, lawyers get involved, how much they can get out of it, whatever. So I'm not, I don't know, but they would sell it at 48 cents. They bought at 46. They did the pump, and then they would, sell into literally just all their shares, hundreds of thousands of shares unloading into all their followers. And then they would have they've got recordings of them joking about their followers getting absolutely effed on these plays. And they have like behind the scenes, recordings and messages of them joking about it. And it's like, holy shit. I mean, if you didn't like these guys, or maybe you thought like, oh, maybe they don't actually pump. I mean, you look at some of that stuff and you're like, holy shit, these guys are true D-bags. Like, seriously. Whether they've come back from it in a better way or not, I mean, it was pretty nasty what I was reading through. So, yeah. About to mention, I did hear about Zach Morris. And the funny thing about Zach Morris is that from what I read through, he actually was probably on the better side. Now, he just kind of screws around a lot, and he did, essentially entice people to buy the stocks and whatever, but I think CEI was one of the biggest ones he was involved in. And he was like, he actually swung, whereas like Laid Back was one of the other names on there. He didn't swing. He said he was going to swing, and he sold every day before the night, and he sold for like a couple cent scalps every time. It was like very minimal, moves that he actually was looking like that he actually took advantage of. Whereas Zach, I think, actually took advantage of some pretty big moves. And did swing. He just, sold when he essentially said he was buying, as well. Or he sold after he said it's going to 10, then 10 minutes later he sold. Like that was what the document said. So like, okay, it wasn't that bad, I guess, for him. But yeah. Elsewhere, yeah, man, it was pretty dirty. These guys. It's funny though. I mean, I feel bad, but it's like looking back, we can laugh. Because they ended up being what we kind of thought they were. Right? Or what people speculated they were. They actually are. I didn't think they made that much money, but 100 million, yeah. No, 100 million, yeah. And so I think that they're going to technically, based off of what the SEC is going after, be liable for those profits. Obviously, potentially more fines and whatever, but they're potentially going to have to give back those gains, which is like, oh, such a shame. Such a shame, But F you guys. I mean, I one of the groups that I was a part of, one of the small cap groups that I was in, we had a guy in there who was like, he's been doing it for I don't know how long he's been doing it, but he was pretty serious about making sure that no one in this group, it was the Prosperity Trading Group, if you guys are familiar. I haven't been in there. I just, don't care to trade small caps momentum based. I'm much more of a swing focused guy, and I can kind of do it myself. I don't really care. And you live and learn. You were in a group and you learn a lot of things, then you move on, right? That's just a natural progression. But he was, when I got in 2019, 2020, he was like, if you see Zach Morris, this name, Ultra Calls, this name, if you see them talk about any of the swings that we are in, for example, like Grill, right? If we had been watching Grill, and if Zach or one of these big names tweeted about Grill, the second they tweet, you get the F out and just move on. Don't, because they're going to, manipulate this thing or whatever they're going to do, volume wise. It's no longer a natural play, so move on. We don't want it, right? And so that's what I was told from 2019, late 2019. I was told that when I first got into small caps, and so I already had that kind of in the back of my head, so I kind of tended to stay away from these guys. But a lot of people who got into the markets because of these guys and Atlas and all that stuff, that's all they knew. And so they got just slaughtered by these people, and it sucks. But yeah, CEI days, remember the legendary pump, $3. I bought at 3, yeah. Thought it would go to 10. Yeah, because Zach was saying 10. He said that was part of the thing. He said 10. He said it's going to 10 plus. And then he ended up selling at like 260 something, all of his 2 million plus shares. And, after he just tweeted it's going to 10. I'm like, oh yeah, sure. Sure it is. I'm going to be out of this. I had a UVXY. I'm going to sell that before the close here. Tis what it is. Put both of those cells on it. Essentially, it was made like a 2% gain on the UVXY. It might be worth a swing, to be honest. I think it could be worth a swing, but I'm not going to hold overnight because I don't really care. And if we wake up, God forbid tomorrow, and we're down at 395 and we all of a sudden dump, then UVXY will probably pop up, and I don't need to be in there for that either. So I'm just not gonna hold overnight. It's crazy. It's crazy, dude. I had some in the back of my head because some of these guys, I was like, yeah, maybe they're actually legit. Maybe they are. I had some kind of hope for that, but no. Proven wrong. Proven dead wrong with what you'll see in there. It's pretty bad. Pretty bad. 29 people in chat line, 5 thumbs up. Hit that thumbs up. I see 22 likes on my end. I don't know. But yeah, I sold those UVXY puts. I think that could be one to watch even to tomorrow and Friday. We'll see how the market looks. But if the market looks like it's got some buyers and it doesn't want to die, I think UVXY puts and VIX short the VIX could be the better play, the cleaner trade. Maybe we could have a nice slow move for tomorrow and Friday versus trying to play calls. Maybe individual stocks could be better setups. Individual. Let's take a look at some stocks. Tesla's down 2.5%. Didn't really do much off of FOMC, to be honest. It popped and didn't really do much. Pretty chill day. Apple 143, a little more volatility there. NVIDIA, AMD pretty weak. So maybe watch AMD. Look at this, AMD's daily chart. Yeah, AMD, if this thing starts to come down under 68 or 69 now, if it comes down, it could be some downside there. Lows of Monday were down at 67.50, so keep an eye on that. It's been relatively weak on AMD compared to, look at NVIDIA's chart versus AMD, way stronger on NVIDIA. So if you're looking for upside tomorrow and the market looks strong and you're playing calls and you want to play, chip plays, NVIDIA is where you want to be for the calls, and if you're looking for downside, AMD is where you want to be for downside. Better opportunities. Enphase up. Look at this Enphase, by the way. Enphase just kind of like keeps on grinding. Looks like it might, if you've got a good day, Enphase, I don't want to say take 350 calls, but like that 350 level, if we go, the market has a firmness to it tomorrow, right? Or Friday, this could finally get a go, right? Towards that 350 plus. It's been a super strong stock the past couple months. So I could look for something like that, potentially in Netflix or Enphase. Intraday wise could be an idea. Caterpillar, look at this. Caterpillar, guys, over 240 and under 225. Over this 240 on Caterpillar could be a breakout for this like flag. It's kind of flagging is what it looks like. It has a nice little flag to it. Somewhat of a downtrend off these wicks. And we've got a under 225 for downside here. It's going to provide a good opportunity. We're up at highs, so over 240 for a breakout move and under 225 eventually for a downside move. We're up towards the higher end of that. So, be more biased towards the call side until, the market proves to us that we're going down. Because it's also been pretty strong, one of those Dow names, I guess. It's also been pretty strong, as Home Depot has been as well the past couple of weeks. So keep that in mind. But that's, I guess, on tap for tomorrow and Friday. Some Wolf of Wall Street activity. Yeah, I mean, I don't know. I would be interested in comparing it and comparing the charges that are brought upon them. And it's just a different day and age with social media and stuff. And how much liability do you actually have, with Twitter and saying stuff on Twitter, and how much can be taken seriously and what technically breaks the law and what doesn't, right? Versus what happened to Jordan Belfort. Like, I wonder the similarities there, because it's kind of, honestly, it seems like a similar situation, believe it or not. So I would be interested. I would be very interested. With that said, though, I'm going to wrap things up for today. I appreciate you guys, like always, for tuning on in. What I got into the Discord, so I'm going to pull it up. I added this. I added fast stock market news to the live stream or the live market news section. It's funny enough, I didn't even realize. I was like, oh yeah, I got a news streamer. I'm all good. I was using Atlas's news streamer because they had connected something similar. And they had like the live tweets coming through. But I connected it to our own because Atlas Discord's gone. Believe it or not. I used it for the news streamer, believe it or not. But I now connected this have our own situation. So this is kind of set up with this account. They pretty much post pretty consistently in terms of intraday news that is important, whether it's FOMC, CPIs, important market data, or just other interesting news that could be worthwhile to have up if you're trading, just so that you don't get caught in some stupid news event that you're like, oh shit, I didn't see it coming. It could be useful. So I have it up in the live market news section. So I'll be using that as my own news streamer. So for free. So it's pretty cool. So with that said, I'm going to wrap things up. I appreciate you guys like always for tuning on in, and hopefully we get a bigger move tomorrow, because today we ended up finishing the day on SPY. We ended up finishing the day down 0.64 and still in this range. So peace out. Thanks for coming on in, and I'll see you guys in the next one. Peace.